Good morning, good afternoon, good evening, and welcome to Martyn Lucas Investor. Smash the like button. Let's get 100 likes in the first few seconds. We're covering the FOMC report live with all the data and show notes from our very special award-winning newsletter accompanying it all at the same time. You want to get this. If you've not got it, it's pinned to the top of the chat. Make sure that you have the newsletter with a 50% off. We didn't do Black Friday, Willy Wonka Wednesday, I don't know, stick it in your hat, flipping Tuesday. We gave you the best deal ever, 50% off, and with an FOMC special, and after the event as well. There it is. You still got a chance to use it. It's out right now. We've got it. It's our show notes. Here it is. I'm going to put it on the screen for you in a second. We've got it. We are ready to rock and roll with the newsletter, and I hope you're all ready to rock and roll. We've got the charts for you. We've got everything you need. And let's get ready to rumble. Okay, are you ready? The FOMC report, the numbers will be out in a few seconds' time. And we can bring it all to you live. And you can trade it as well. So, are you good to go? Is everybody ready? Have you smashed the like button? Have you subscribed? I'm wearing a gold jacket. The studio is gold because it's a golden opportunity to make money on these events. It really is that easy. It's easy to make money. The hard part is to keep it. Live comments and questions. You can be live on the show as well. There's a live phone in. If you want to be part of the show, you can be on it. There is the live video link in the chat right now. There you go. There are 10 spots. You can be on the show with me in these spots here. You can take part in today's show. We've got everything ready to rock and roll. It's going to be an explosive day today. I hope you're ready. And to accompany all of this, we have the notes as well for you from the trades. Let me show you everything. I'll give you a little taster what's in our newsletter. This has just gone out a few seconds ago to all of those of you who got it. You can still get it. Be prepared for all the information during the event today. So I'm going to give you the link again. Make sure you got the newsletter. You can get it right now. I've posted it 3 times, 50% off. I've also got some charts. Let me spin through. I can't share all this. This is for our viewers to take advantage of and trade it. So we've got CFDs on silver. We've got a chart in there for that. We've got a chart for Bitcoin, what to look out for, where to buy, where to sell, all the support levels. We've also got a chart for XRP. Look at all these charts today. S&P 500 showing you these. This has just been done a few seconds ago, giving you all the advantages over the FOMC report. You still got chance to sign up for it if you want to get it. All right, don't miss it. We're also going to give you magic numbers in this show in a few seconds' time. Right at the beginning of the show, we're going to give you your first magic number to win $2,000 free. No purchase necessary, no downloads necessary, a completely and utterly free competition to enter. It's completely free. So if you'd like to win and be in our competition, you can. I'm going to give you the link here. I'm going to give you the link for the giveaway. This is the giveaway link. martynlucas.com/giveaway. Let me drop it in here for you. There you go. There is the giveaway. It's free to enter, free for all. You can win by just reposting and sharing and subscribing. Very, very simple. Read to the bottom, read the terms and conditions. It's free to enter, free for all, very simple. You just got to sign in. We've got once you've signed in, you'll see this, a repost on X. If you follow me on X already, it's already done. All you got to do is repost this and claim some tickets. Also, we're going to give you the magic number. I'm about to tell Sensei now. Let me tell Sensei that I'm giving the magic number now because he's on the other stream. So Sensei, giving first whoops, Daisy first. Can I just say it? It'd be easier. Oh God, not now. Number in 1 minute. Okay. Sensei, giving first number in 1 minute. So I've just told Sensei I'm about to give the first magic number. That'll be here in our giveaway. It tells you here how you can enter the magic numbers. I'm going to give away one. Sensei will give away the next one halfway through the event, and then I will give the one at the end. All right, that's how we're going to do it. All right, so there's the giveaway. You've all got the link. It's below in the description of the video. We're just 20 minutes away from the announcement of the rate, and then we're going to get the presentation. The presentation is more important than the actual the rate itself. All right, very, very important. Okay, so are you ready? We're about to give you your first magic number. Going to count down for 1 minute. Hopefully you will be ready. Hopefully everybody on Sensei's show is ready. We're running 2 shows at the same time, so you can take part and be involved in everything. Here is Sensei's show. This is where Sensei's live right now. Here he is on the same channel at the same time, giving a different perspective. There's Sensei. He's got a nice suit on. Oh, hang on. Star guest on the show. What's this?
Adaric 3 donated $2 through a super chat. Crypto is pumping before the announcement.
Well, it's not really pumping, but it's up. You're right. 2.95 on Ethereum is pretty good, but I wouldn't call that a pump. Ethereum, XRP is down. It's moved a bit, but it's not really pumping. It's just up. But thank you for letting me know, though. I did get a chance to look at it. Up 0.32 today. Not a massive jump, but nevertheless, it is a move. You're right. It is a move. Right. First magic number. Write this down. Comes to you in 30 seconds. Are you ready? First magic number. I'm going to make sure that everybody on Sensei's channel has the magic number. I'm going to drop it in the chat to him now. Here we go. First magic number. Whoops. This is to win $2,000. First magic. Can't write it. Number in 30 seconds on my show. There we go. Let me drop that into there. First magic number in 30 seconds on my show. I've just dropped that in so everyone can see it. So we're going to count down 30 seconds and we're going to give you your first magic number. Right. So are you ready? Stand by. 10 seconds. I think we'll go there. Shall we go there? 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Your first magic number to win $2,000. Remember, all you have to do is add them together. Add them together, enter them into the competition page. The information is below in the description on this video. I've given you several times. It's below every video. It's also on our X account. You can see all of that. So here is your first magic number. I'm giving it to you now. The magic number is 100. 100. Your first magic number is 100. 100. 100. Okay, you all have the magic number. Fantastic. There'll be another one. The next one will be with Sensei. I will tell you when Sensei is going to give it. He'll let his audience know when they're going to get it, so you don't have to rush. You can stay where you are. You can relax. The next number will come up later on in the middle of the show on Sensei's show, and then the last one will be back with me. Right, we have got just over 15 minutes to go before we get the announcement. Are you excited? It's very, very exciting. Woo! It's an opportunity to make money. Let's go over once again to the newsletter and look at some of the charts from Sensei's FOMC special. This is the S&P 500 chart. If you've got the newsletter, you can follow along with this and you can see all the trades and all the positions we are giving you so you can make an informed a trade. I'll drop it in the chat there. I've got a guest wants to call in and be on the show. You have to be on camera. Let's have a look. A guest number 1. Yep, if you want to be on the show, I'll give you all the links now. Anyone can call in, be on the show. You have to be a member. You have to be part of it. There is the link. Let me invite guest number 1 on the show. This is Choro. Good afternoon to you, Choro. How are you?
Oh, pretty good. How are you, Martin?
I'm very well. Lovely to have you on the show. We've only got 15 minutes to go. How can I help you?
How's Leah?
Leah's fine. Thank you for asking. Very well. Thank you.
All right. Been watching for a while, man. Prayed for her when she was in the hospital too. Just so you know that.
Thank you.
Actually, I got some stuff to ask you though, like from real talk, because you're about one of the realest guys I watch on here.
Thank you.
So a while back, whenever you were jogging, walking, and you were really down on crypto, it's like, okay, well, better watch my crypto. Next day you were driving, talked about crypto, XRP, Bitcoin going to 0 possibly. And then the next day, when I'm sorry you were in the hospital, we found out you had a whole Bitcoin. And I understand you want to know what it felt like. I bet it was pretty cool. But as a watcher, when you get off the show and then your account is differently or you buy something differently, it kind of puts us in the shadow. So my question is, how do we, because we know you make great moves, but when we see it, like even that day when you bought it, Bitcoin was low. And when you sold it the next day, man, I'm sure you made a huge profit. And with the XRP.
Yeah.
But we were left in the shadows again. Like even when you drove to
I'm just losing your signal. I'm just losing you a little bit. Your internet just dropped a little bit.
About that.
Yeah, it's catching up.
You still got me?
Yeah, I've still got you.
Okay, great. So again, when you drove and you went and talked to the Bank of America representative, we were still, I'm talking as, I'm not trying to speak for everybody, but myself, I was still left in the blue of, okay, he went and talked to him and we got like a whole nother day that we couldn't understand. Is XRP real? Did the Bank of America get it? So how can we get more of an, because I'm not saying you're right or wrong because you're great, but we're just left in the shadow at those times. Personally.
Okay, well,
how do we go about getting out of that?
Okay, I'm going to ask you really quickly because we're getting very close to the FOMC report. It's just 14 minutes away.
Yes, sir.
So every single trade that I do, before I do it, I put it on my X and my Instagram and Facebook and Discord, all out every single time I do it. So do you follow me on X and Instagram or any of those places?
No, I don't have X or Instagram. I try not to get in there because I get in there and then the next thing I know, I'm in there forever.
Okay, well, that's how I do it.
I could join your Discord. I don't mind joining your Discord.
Yeah, you can join Discord. It's on there. I also post it on the community page of YouTube as well. I'm also doing that. And then very often I go live. Have you rung the bell? There's a TV playing in the background. If you can just mute it a second, we can all hear the TV. Thank you very much. Also, if you've rung the bell, when you subscribe, have you rung the bell so you're notified when I go live? Because I very often just pick up my phone and say, guys, you have done. Okay, so you've done that and you've got that turned on. Well, really, I do everything live. I post it on all my socials as I do it live. I can't do no more than what I do. And if you're ever in any doubt about anything at all, do what you're doing now. Call into my show, go into the live chat, and I will answer it for you. But I strongly suggest, though, you shouldn't be following my trades anyway. I know you want the information to see what I'm doing, and I respect that. But
well, you got great information from the bigwigs. Like we know this, you got some great connections.
Yeah.
But again, my only thing, so you're saying that if I had your Discord, I would have seen that you bought that Bitcoin when you did?
Yes, you would have done. Yes, my Discord premium is $2.99 a month. It's not open to the public. The public stuff, I just don't use it. It's just the premium service, $2.99. It's on my X, it's on my Instagram, it's on my Facebook, it's on YouTube, Discord, YouTube community page where you're already on there. I post it there, and I'll pick up and do a short. So yeah, that's the best way. If you miss it, of course, life gets in the way, I understand, but I do post everything before, during, and after. Yep, I try to keep people updated as much as I can.
I'm glad you clarified that.
Okay.
As a guy that likes you, follows you, loves you.
Appreciate that, mate.
Yeah, that's what's been pushing me away from joining a lot of your memberships, because that bothered the crap out of me. I'm like, man, he's so great, but when that happened, it hurt, my feelings.
That's the best I can do. I mean, I'm more in touch than anybody else online. You are literally talking to me now. I'll just get rid of that a second.
Yeah, I know. I thought this was again. I thought, and even I thought this a while back was, oh man, people, that wasn't real, but it's real.
It's
I'll
real.
tell all the members this is 100%.
This is real. I've really got to push you, because we got thousands of people.
FOMC. I get it. Hey, I apprate your time.
You can call it anytime. Yes.
Will the newsletter cover you or just Sensei? Like if I pay the $100, will I also get all your stuff? And or do I still have to go into Discord, pay for Discord, and then subscribe on your subscriber? Is there a one ticket all kind of thing?
Let me ask Sensei if I could share that into the community on the newsletter. I know I can. It's another thing for me to do. Let me see if I can allow the time to do that.
But if I got that, that wouldn't get me in Discord though, right?
No, it'd be separate. But that's a good idea. It's a good idea, and I could say to Sensei, because I know we have a community page in his newsletter where you can post things. I could go in and post things about my trades, and then you could follow me on his newsletter. That would be an extra. You just come up with a great idea as a wonderful perk for all our newsletter readers. I could actually
get a free one on that one.
You just cost me money there, but anyway, I could actually write that. Let me talk to Sensei. It's another thing to do, another process, but I could probably do that and make the newsletter even more valuable.
At this moment, though, the newsletter is kind of following Sensei, right? That's what Sensei comes out.
It's Sensei's news,
not particularly
absolutely.
You.
It's not my trades,
and
no.
you don't have an actual newsletter.
I don't.
Yourself.
I don't.
But you plan on kind of being on that with them?
Well, it is my newsletter that Sensei runs for me. So it is my newsletter.
Okay.
But
all right.
This is my channel. I've really got to go, but I tell you what I'll do.
I know we got to get to the FOMC.
Let me speak to Sensei, and I will say about putting my trades into the newsletter. How about that? That'd be great, right?
Sounds great. I appreciate your time, Martin.
Thank you. Cheers, mate. Have a good day. There you go. Fantastic.
Yes, sir. You same.
There we go. I had to push the guy, of course, because we're seconds away and everyone's tuning in for the FOMC report. But that's what this show's about. We're all about every individual person. It's not just about me. No matter how big the event is, we'll always make the time for every person. Everybody can call in. Of course, I had to push him a little bit because obviously, we're up against it, but there you go. All right. So the FOMC report. Are you ready? It's a big afternoon. So let's get ready. We've got 8 minutes to go. We're going to bring you the information. Sensei is covering from his perspective. I'm doing it from my perspective. Fundamentals. We have a different approach. I'm sure you all appreciate that. Okay. All right. So let's get ready to go. And the reason why we've done 2 different streams at the same time on the same channel is because you all like it presented a different way. So we're trying to give you the best. Now here is the newsletter. You can still get it. What our guest was talking about. Maybe well, not maybe. I will speak to Sensei about that. That would be a wonderful thing, right? I could share my moves into the newsletter. If you like that, by the way, if you like that and you'd like me to post my trades in the newsletter as it happens on the community page, just say yes in the chat. If there's enough support for it, I'll have a chat with Sensei, and you never know, that might happen. So anyway, tap the like button. We are 7 minutes to go. Just say yes or no in the chat if you like that idea. There is the newsletter. If you want to call in as well, I'll give you the link here as well. If you want to ask a question, just like that, you can. Now, what I'd like to do is get all 10 spots filled up here. All 10 spots filled up here. When the FOMC report, you can react to it. So if you like what Jerome Powell is saying, you can thumbs up. If you don't like what Jerome Powell is saying, you can down like. There's another little thing for you. So if you want to call in, it looks like everybody loves that idea. Oh my gosh, everybody loves that idea. Right, there is the link to call in. We want to fill all 10 spots up, first come, first serve, and you can be on the show as we cover. Now, we've got 6 minutes to go. We are waiting. We've got everything ready to rock and roll. We're on standby now. So stand by, get ready for an explosive afternoon. Here is the details on Sensei's newsletter, this little show notes here. Everybody else, typical on the right-hand side over here. Let me just click here. You can see you get all this bloody nonsense over here. This is our newsletter on the screen. You can pause that. I'm not going to talk about it too much. We've got another guest calling in. We've got so much going on. FOMC report is just seconds away. RV Investments would like to join. I'm going to put you in spot number 1. You have to be on camera. If you're not on camera, I'll have to hang up on you. You are not on camera, so I've got to hang up. Oh, he's on camera. Oh, he's off now. Okay. All right, we got 5 minutes to go. Are you ready? If you all tap the like button. All right? So 30 seconds. 30 seconds. We want 200 likes in 30 seconds. Going to play the music. Here it comes in 3, 2, 1.
The year is 1991. Birds and people
200 likes
together in seemingly perfect harmony until one day a young
Here we go.
man catches fire. This is Phoenix.
159. We want 200 likes. We got 3 minutes to go. 159. 167. 167. There's Sensei, look. Absolutely brilliant. 175. 25 more to go. $198. 2 more. 4 minutes to go before the FOMC report. Tap the like button. Consider subscribing. 4 minutes to go. Have we done it? Have we done it? Let's have a quick look. Here we go. 107,000. We've hit another target on the way to 1 million within 2 years. Thank you. Did we do it? 229. Smash. We did it. Thank you very much indeed. 3 minutes to go. 3 minutes to go before the FOMC report. So are you ready? A huge day ahead of us. Get ready for extreme volatility. I've sold my SGov. I've got all my positions out of SGov. I've got my position in Coca-Cola, my defensive play. I've got $384,000, nearly $500,000 ready to go. I've just sold my SGovs. There you go. Put that in the newsletter. I've just sold my SGov, my treasury bills to buy. 2 minutes to go. Are you ready? We're ready. Okay. Seconds to go now. FOMC report is here. Woo! Always win. Always win. Are you ready? Okay. It now goes quiet. We're seconds to go. We've got exactly 2 minutes time. I hope you're excited. I hope you are not stressed. Remember, the economy is not the stock market. They are different. If you are into XRP today, don't worry. Don't panic. If you know what you own, you are okay. You shouldn't be like this guy. You should always do your numbers. If you do your numbers, you will be fine. Is today going to be an up-down day? What do you think? Are we going to the moon today? A phrase I hate, made up by influencers on YouTube with crypto. Rubbish, nonsense. What we want to talk about is, are we standing on the moon? I know, just as silly, right? Just as silly. Anyway, the point is, are we going to go up or are we going to crash? Let me tell you, if we get a rate hike, crypto is down 80%. If we get a 0.5 cut, that will shock the market. Crypto is down big. If we get nothing, a pause, crypto is down big. If we get a 0.25 with a good tone, it kind of goes sideways. The biggest story then will be what happens at the end of the conference when we have the presentation with Jerome Powell. And then the bonds reaction, and then December 19th for the carry trade. Here we go.
We could get multiple descents.
Stand by.
And I think they're going to really push it out and say, don't expect another near-term cut.
Jim, I don't want to look too far ahead of today because it does matter. 90% chance of a Fed rate cut today. Looking at the CME FedWatch tool, you got about a 25% chance
Here we go.
in the market of a rate cut. At
20 seconds to go.
28 meeting, first one of next year. Where do you land on the next possible cut?
So on the next possible cut, it's going to be all dependent on what happens in the labor market. The labor market is really the key messaging for the Fed. The Fed has to be careful, though, right?
3,
it doesn't want to walk into a policy mistake
1.
by being either too
we
hawkish
are
or too
previously
dovish.
4%, forecast consensus 3.75. The number is, the Fed rate decision is,
so if
we are on standby.
Continues to weaken. If it softens further, then I think January
forecast consensus.
If it doesn't,
it's a pause. It's a pause. There's no rate cut. No, I beg your pardon. There is a cut of 0.25. A cut, as expected, 0.25. We have a cut of 0.25. 0.25 cut. Here we go.
The Federal Reserve reducing interest rates by an expected quarter point to a new range of 3.5 to 3.75. There were 3 dissents. The first time that's happened since September 2019. 2 were against the cut, including Chicago Fed President Austin Goolsbee, along with
hardly moving. Exactly what I said. If we got a pause, nothing much, and we're getting nothing much. Sorry, 0.25, nothing much. XRP is not pumping. People said it would. I said it wouldn't. It's not.
50 basis points. The Fed signaled a higher bar for the next cut, using language that it's used in the past to do so, saying that it will assess incoming data to determine the extent and timing of future rate moves. That language it used it last December to signal a pause. The rate outlook suggests consensus for just 1 more cut next year and 1 more in 2027. But as I'll get to when I talk about the dot plot, a lot of disagreement. Before the dot plot, though, I want to talk about some pretty big news when it comes to the balance sheet. The committee making a determination, it is now at what it calls an ample level of reserves. So it plans to initiate purchases of shorter-term treasuries on an ongoing basis. And then a separate document was specific, saying the Fed will begin buying $40 billion in bills starting December 12th. That's just a couple days from now. And I believe that's sooner than the market expected. And those purchases will go on for a little while at an elevated level because of seasonal demands for reserves that are out there before coming down again in April. That's what the document says. Outlook on the economy in the statement. GDP outlook was stronger next year in the Fed's own forecast, up 0.5 point to 2.4%. So pretty big move there in the outlook for GDP next year. The inflation outlook lower for next year by just a tick, down to 2.5%, just about hitting the target of 2.1 in 2027. The statement says the economy is expanding at a moderate pace. Job gains have slowed and unemployment has edged up. Just a note, the statement no longer says that the unemployment rate is low at the current rate. Inflation is seen as somewhat elevated. Economic uncertainty also elevated. Back to the Fed outlook and the dot plot real quickly here. Only 2 dissents, but 6 officials in total wanted no change in the funds rate according to the dot plot. So kind of a soft descent in that regard, you can call it. 7 want no change at all for next year. 11 only want 1 cut next year. One person, and we can imagine who that is, Stephen Myron, just guessing here, wants rates down to 2.12% next year, or 150 basis points lower. And that is the statement and the outlook for rate cuts and the balance sheet. Mr. Sullivan.
Quickly, sir, you said buying bills maybe sooner than the market expected. This is not QE. I do not dare call it that. But is this like the son of QE, quantitative easing light?
You know, Brian, people are going to take off on this, and I don't want to stop the craziness that'll happen in social media and on the interweb. The Fed will say this is maintenance of its balance sheet at a level of GDP of where it was. Some people, however, will call it QE light. Some people will call
crypto
it
has hardly moved.
I believe the Fed will say this is neither.
We're going sideways.
Maintaining the balance sheet at what they call the ample level of reserves.
It's now all down to how he addresses it.
Them to begin buying $40 billion of bills. It looks like 3 years. They also may go out a little bit into the bond market as well.
We've got a guest. You can now be on the show. Our first guest is calling in. He wants to share reaction. You two can be on the show.
And Brian, call it what you will.
Let's see what Rick Santelli calls it. Steve, stay right there as you continue to dig through this. The market reaction initially showed a very dovish tilt. We have stocks moving to session highs. We have bond yields falling. Rick, your interpretation?
Well, my interpretation, Steve nailed it. I don't disagree with social media going hog wild. They could put any spin on it they want. Ample reserves to deal with the reverse repo market issues, but it is QE, call it QE light. And once again, I have an issue with this, and my issue is simple. Every crisis, they expand the balance sheet by buying securities to manage rates or manipulate rates, pick any M word you want. But in the end, this is something to really pay attention to. And finally, the markets themselves, we saw a couple of basis point drop pretty much across the whole curve. 358 down to 356 in a 2-year. 10s were hovering right around that 416 level. They dropped about 2 basis points to 13 and change. They're right back to 415. What's notable is where we were this morning. As Brian pointed out, the fact that we're toying with 420. Remember, we closed at 457 last year. We're getting ever close to unchanged on the year. On a year that many analysts and experts thought we'd be spending a boatload of time under 4%. We've had a total of 8 sessions close under 4% so far in 2025. The dollar index, no surprise there. It's down about 1/3 of a cent. It was down about 1/4 of a cent before the statement was read. It's definitely toying with this 98 3/4 to 99 level. It seems to have lost its hunt for 100 recently, but that makes sense considering the Fed's easing. And finally, the next meeting, January. Many are talking about the January 28th meeting. For a while today, we had about a 30% probability of a 1/4 point ease. That's now moved to around 24%.
You see what I said? It's all priced in. Crypto hasn't even moved.
Meeting, that's also hovering around a 25%.
I'm waiting to re-enter the S&P. I'm not going to buy it yet.
The real issue
I'm already in anyway.
Is how much the market's going to pull out on the easing mentality as we continue to get data that certainly doesn't look like the labor market is dying a quick death. And in terms of inflation, not a lot's changed in the last 16 months. It's sticky, and it doesn't seem to be coming down closer to the Fed's target.
Rick, appreciate it, and we'll circle back in a moment. But let's get more from Mike Santoli. Mike, on what jumps out to you about the market's reaction here and what the Fed just told us.
Yeah, sort of net positive. I wouldn't say it's a real vociferous reaction. Obviously, it's during the press conference that we sometimes get more of the swings or the rethink or the unwind of the unwind. We know the drill on Fed days. But there has been a value over growth, cyclical stocks over defensive stocks, financials leading, especially banks. That has meant that the market has been kind of revving in this direction of anticipating a firmer economic performance in the early part of next year. We could be proven wrong on that, but the market seems pretty resolute in trying that hand. And I don't think that today's cut and going on hold because we weren't priced for further cuts in the coming months is necessarily enough of a surprise to disturb that in any respect. I mean, if Fed was on hold from December of last year till September of this year.
What do you think, High Energy? You like it?
But it was not really
Thumbs
a
up.
rates issue. So the longer term coming in a little bit in yield, maybe that does loosen things up a little bit.
You want to be on the show? Join High Energy. I'll give you the link in the chat now.
All right, Michael Santilli. Michael, thank you very much. All right, let's go back now to our panel. We got Jim, Francis, and David. Francis, I want to go to you because let's talk about the job market. And I'm going to compare the last meeting.
Okay, we're going to discuss it now.
Look down and read it. Here's what they said at the last meeting minutes.
We've got enough information. So if you want to call in, you can be live on the show. Just give me a quick thought. High Energy, did you like it? We got 0.25% as expected.
It was expected, but when you said pause, I about had a heart attack.
Yeah.
But it was expected.
I'm just going to mute you because there's a huge amount of noise.
I'm about to go in my truck. I'm getting my dog in. And,
all right.
Come on, let's go. I'm jumping in my truck.
All right. Cheers. Thank you.
Just pause me and I'll be right back on.
All right. Okay. Thank you. Bloody hell. That was a noise, wasn't it? It's like a bloody up a rocket. Sorry about that. When it first went live, I went, I'll pause and I meant 0.25. Everybody got I got that clear. So essentially what we had was as expected. So the markets aren't doing that much. We're up 0.1112, whatever. I'm going to wait. Defensive has gone down a bit, but I'm still up on it. I'm very happy. But you can see crypto hasn't done anything because it's as expected. Nothing. If we got a 0.5%, it would have been a disaster. If we got a pause, it would have been a disaster. If we got a hike, it would be a disaster. We got a 0.25 as expected. Like I've been saying, it's baked in. Nothing's going to happen. No real reason for anything to rally or dump or anything. So what we're going to do now is wait for the sentiment. And when Jerome Powell starts to speak in exactly 20 minutes from now, then we will get an idea of what the sentiment is. And when we get the sentiment, then we'll be able to really measure this. So you're going to see swings, like they just said. You are going to see swings. So I am happy. We got a 0.25 as expected, but it's how Jerome Powell delivers the speech. Does he come across dovish, or does he like, God, there's no more rate cuts for a long time? Who knows? We shall see. What are we going to get now? So now the S&P is just starting to sell again. Going to wait. Remember, it's still 29 times earnings. We're not rushing out to buy, but we want to get the market will trade this. So the moment we get an opportunity for it to sell, then we can start nudging a bit back. I'm not going to go all in though, because we are going to get bigger dips. The carry trade is still a real deal. We've got past this first hurdle. Great. We're getting a rate cut. It's nice. 0.25. We got what we expected. Everything is fine. Nothing too dramatic. Nothing too scary, but we don't want to be jumping in my opinion. I'm just going to wait. I'm going to wait for a pullback, and there will be one. I do not expect the markets to rally and go crazy at all. We're more interested in the sentiment from Jerome Powell. Let me just ask iEnergy what his thoughts were. If you want to call in, you can be on as well. So let me give you the link there. We got 15 minutes before the presentation begins from Jerome Powell. That's the most important part. There you go. If you want to call in and join High Energy, I'm going to give you just a second to give me your thoughts. There you go. Let me know what you think. How do you feel about it? 0.25.
What do you think? How do you feel about it? 0.25. It was as expected. I think I was kind of wanting a pause because I'm looking to buy more XRP and possibly get into some Ethereum, some ETH. Quick question for you.
Yeah.
Are you looking to re-enter into crypto?
Not at the moment, no. I do want to buy. I do want to buy XRP. Can you just mute? Can you mute your device? I've got two devices playing. I do want XRP, and I'm interested in Bitcoin, but not at the current conditions. And we're not just talking about price. I never focus on price. I focus on value and macro conditions. And there are things that are concerning me around XRP and Bitcoin. So I I'd like to be back in the space. As you know, I use XRP to give away in my prices, and I'd like to own some Bitcoin again, maybe a Bitcoin or two. But I'm not at the moment. Not happy with it. I'd rather be where I am in the S&P and defensive, particularly because of the carry trade unwind. Because crypto, of course, will go down a lot more than the S&P. Does that answer your question?
Yeah, I agree with you. My situation is I started buying XRP at 41 cents. I took out a large amount when it went to 250 about 18 months ago, bought back in. I've got 10,000 coins at about $1.65. So I'm just holding right now. Yeah. So I actually personally wouldn't buy anymore until it gets lower than that. All right. So I'm just going to hold and take it from there.
Thank you. Hold a second. Let me go to Sean Morris. Sean Morris, hello. How are you? How can I help you? Where are you calling in from?
Michigan.
Michigan. Lovely to have you here. Thank you very much. What's your question or comment?
Not much. Just kind of what we expected. Glad to see crypto not dumping.
Just going sideways, right? Just going sideways for the minute. Yeah. I think it's more important what Jerome Powell says in the speech, which will move the market. So I'm looking to buy a bit more of the S&P. I'm not looking to buy crypto at the moment, but I am very aware, and I'll be keeping my eye down of what happens with the carry trade. It is unwinding already. It's whether we get that rate hike in Japan, which will then send it over the top. All right. If you guys want to stay on standby, I can mute you, and then basically when the event happens, you can react. You can thumbs up, down. You can be part of the event if you'd like to. If anybody else wants to join our team here, we've got 10 spots available. You can be with me on the screen. You can jump in at any point, ask me questions. You can react up or downwards, whether you like what you're hearing. Excuse me. Guys, stand by. We got Jerome Powell and the FOMC just 15 minutes to go. We've got plenty of time. I'm not going to give out the magic number yet for quite a while. There's a little way to go. When I get close to it, I will tell you that Sensei is going to give out the magic number. He will give out the magic number on his show, and then he will send you back because I will do the magic number at the end. All right? So, okay. So where are we right now? The market, as you can see, started to sell back off again. So a pause was exactly like I said. If we get a pause, it's already baked in. Don't expect a pump. Don't expect a dump. It depends on sentiment. So we're waiting for that. But as you can see, I did get just a little bit up and a bit down again. It's kind of going nowhere. We're not going to jump in. I'm going to hold and I'm going to wait and see a little while longer. All right, so we've got 14 and a half minutes to go, so stand by. If you just tuned in, please consider subscribing and also tap the like button. And you may have noticed I just did that literally back to front, the wrong way around. So we are doing 2 streams at the same time. This is Sensei's version of the same show. He is covering it from a different perspective. Here is Sensei. I'll give this to you. Pop in, say hello, pop back, run 2 at the same time. That's what the majority of people are doing. All right, so there is the link, okay? Good stuff. All right, then. So let's get ready for this. We are now holding up 0.12. We're not doing anything at the moment. Let's go back to comments and questions. So congratulations, 1970 Buckley. What have we got here? Watching from Dallas City Hall with closed captions. LOL. Last City Council meeting of the year. Lovely. City Council in Dallas. You're not very far from me. 1970 Buckley, just down the road, in fact. Lovely to have you with me. Thank you for everything that you do, supporting the channel with memberships and everything else. Absolutely incredible. Right, what's Bitcoin doing? Ethereum, up, down, kind of. Ethereum's done well today, but it did this before the rate cut, remember? XRP's done hardly anything. It's back down. It popped up yesterday on this potential short squeeze, and it's sold back off again. Not really gone anywhere. It's all expected. Bitcoin hasn't done anything either. Popped up, sold off, popped up, sold off. It's where we expect it to be. And done all that. Okay. My Coca-Cola defensive position, not really done much. I'm still in the money. Didn't go low enough to buy more. Didn't go high enough to sell. Not really doing anything. I want to hold it for the dividends. My S-Gov, I've sold it all. As you can see, I'm all out. $32 left. I sold it all out. And There is the S&P. I've now got 384,000 in buying power. I've got $100,000 invested in the S&P. I'm up on it, which is wonderful, really great. But we're just waiting now for the next move. Let me go to comments and questions. It's Christmas time to phone in and feel free, all spots, to spin the wheel. We could do another spin the wheel. We could do spin the wheel. LOL, Martin, check the Bitcoin chart. It broke 93. I just did share it with you. I've got a chart to share with you as well. This is from the newsletter, which you can still have, and there's another one coming later on, post FOMC report. Here is the... in fact, I don't need that anymore, do I? I just need this one. Newsletter, here we go. 50% off today, ends in a couple of hours' time at the end of the FOMC. The very best time. There'll never be a better deal than that. Absolutely 100% will never be a better deal than that. Martin, I'm winning on SAP. Do you mean S&P? S&P? It stands for Standard & Poor. They are a ratings agency. You're winning. Yes, you are. You are winning. Congratulations. We're all winning on the S&P. We're approaching an all-time high. So not that that's a problem, of course. That's a good thing. Anyway, here is the some information from the newsletter. I'm going to show you this. So we're looking forward, the Civil War and the bond trap. This was in the newsletter a few seconds ago that Sensei just posted. While the December cut is locked, 80% probability. This was just before the newsletter, before it dropped. We now know what it is. The path for 2026 is fracturing. The market is ignoring two massive risks. The neutral rate, Civil War. The Civil War, the Fed is quietly splitting into two camps over the neutral rate, the theoretical level where they stop cutting. Estimates now range widely from 2.6 to 3.9, creating a chaotic policy path. The doves, example, Miran, argue the neutral rate is low, 2.5%. They want aggressive cuts to save the economy. The hawks argue AI productivity has raised the neutral rate. 3.5%. They believe the Fed is already there. If the hawks win, the cutting cycle is effectively over today. The shadow chair and the trapdoor, the primary risk for 2026 is political, with Kevin Hassett, Trump's NEC director, favored to replace Powell in May. Markets may start pricing in his loose money policies early. This creates a trapdoor scenario for the bond market. See image below. We'll have a look in a second. The mechanism, if bond vigilantes believe a Hassett-led Fed will tolerate higher inflation, they will sell long-term treasuries. The result, the Fed cuts rates, but mortgages long-term rates go up. This bear steepener tightens financial conditions, even as Powell tries to loosen them. If you've got this, I'm not going to show you too much. This is from our special FOMC newsletter. If you didn't get it, you can still get it. There'll be one afterwards, and there'll be one tomorrow as well. Every single day you get this with 50% off. The very best deal we have ever done. All right then. So let's get ready. We've got 9 minutes to go. 9 minutes to go before the FOMC report. We're just moments away from the event really starting. That's what it's all about. You can call in, be on the show however you like. Let me just pop into Sensei, because we're going to be giving the magic number in about 15, 20 minutes. I'll tell you when. So just stay on standby. I will give you that information very, very shortly. So stand by for that. All right? Okay. So we're just on a hold right now. Let me do some more comments and questions. Martin, I'm winning. I'm so pleased to hear that. Guys, are you seeing the same on Archer that we found in consolidation? Tricks, thank you for your thoughts. I've got to focus on my members, I'm afraid, at the moment. Is XRP over if the banks are not using it for payments? It's a good question. If the banks don't, I mean, at the end of the day, I'm not interested in a token that doesn't do anything, just trades in and out, and you're hoping that people will buy it off you for more money than you bought it for. Not interested in that. I'm only interested in assets that have value. Now, the coin itself has no value. What is the value is if it's used for transactions, and every time it's used, it burns a bit more of XRP, thereby reducing the supply, thereby makes money for the banks. They use it. I get it. It makes perfect sense. So yeah, if nobody used it, it was just some random coin like Binky Bonk or Fart Coin, then yeah, it serves no purpose. I wouldn't even consider looking at it ever again. But we do believe that Bank of America is using it. They've been testing it. It was even mentioned on one of the earnings calls, hence why I covered it. But so that, I hope that answers your question. Potato Family is always right, beating the market. 1 out of 0. Love it. Fed buying 40 billion treasury bills over the next 30 days. Quantitative easing now starting, said Vocal Fosser. Is SPY going to pump or dump? What's your prediction? Well, I think the market, it's already expected. This rate cut was already in. So, as I said, it just went up and back down again. Crypto is not doing anything really to shout about. Let's be honest. It's up. Ethereum is up a little bit, but that's because of the use case, because of the exchanges that are using it. My defensive play, Coca-Cola, is flat. I'm neither in or out of the money. It wasn't worth selling earlier for a 1% profit. I was up like $300. It wasn't worth it to me. I'd rather just buy more. The S&P, what you're asking me, will it pump today? Well, I think we'll get volatility during Jerome Powell's speech in 5 minutes' time. We'll get ups and downs, absolutely. But I am overshadowing all of this is the carry trade. I cannot emphasize that enough, because if bonds go crazy and the yen carry trade unwinds, then the market's down 30-40%. It's due a pullback. We're 29 times earnings on the S&P. It doesn't matter what you do with the rates. We're 29 times earning on the S&P. People with money just don't want to buy it. You know, if I was selling you a can of Coke for $1 and you could buy it for $1 in all the shops, that's its value, you'd pay $1, right? If I said it was 50 cents, it's half its value, you'd buy it because you could sell it for $1. If I said it was $1,000 like Palantir, 1,000 times its value, would you buy it? What would be the point? One day it would be worth $1,000. Well, what's the? It's never. I mean, inflation would have to go up for about 1 million years for it to go to $1,000, isn't it? So that's where we are. We're 29 times earnings now. So for every dollar the S&P earns, it costs you $29 to buy that profit. Who's buying it? No one's buying it. So what we need? What do we need for the market to continue to rise? We need inflation. That's why you have to have inflation. So money is devalued. So stocks go up in price. Things go up in price. They're not making more money. If everyone buys Coca-Cola today and everyone buys Coca-Cola in 10 years and there's the same amount of people on the planet, they're not growing the business. They're just sustaining it. It's making more money because the price of the Coca-Cola has gone up. So the stock has gone up, but only because inflation's gone up and money's been devalued. So we either have to wait for inflation to go up and 2% a year, so stock market goes up 2% a year. Okay, we got that built in. What about any more? Well, then we need growth. New businesses that enter the market, move into the S&P, rise up the ranks and grow. Is Apple growing? You decide. If everyone's got an iPhone, it's just going sideways, right? So it's all to do with inflation. They sell expensive products that could go up with inflation. So there is your share price. There it is. So right now, how can you buy the market at 29 times earnings? You can't, can you? Especially when you think that the market is about to unwind with the yen carry trade. So we have to consider these things. All right. So there we go. Anyway, there it is. So that's where we are today. All right. So here we are. We've got 4 minutes to go, so let's get ready.
Price.
Here we go. They're on a commercial break. So we're just on standby now. We've got 3 minutes before Jerome Powell takes the stage. When Jerome Powell takes the stage, we will be able to hear what he has to say, and then we'll get something out of it. But this will be the main part of when it swings. As you can see, as I said, I was right. If we get a 0.25, it would be sideways. We went sideways. Everybody reacted. The markets always overreact. They always overbuy and they oversell. So we're waiting for, they overbought and now we're waiting for them to oversell. So hopefully at some point in the next hour, we'll get the market trim off. I'll buy some more. I won't go all in. I'll be back in treasury bills by the end of the day. I want to make sure that I've got a decent amount of cash to buy the yen carry trade, but I don't mind being in and it falling below. That's okay. I don't mind that. Not a problem at all. That's why I have cash equivalents on hand. And also I've got margin if we drop 40% because I can't time the market. And then I'll use margin to buy when we crash 40%. And as I go up, and we meet where we are today, I sell these ones and keep the ones I bought 40% less. That way I don't pay tax on the ones that I bought that I have now because I'll sell for a wash, but I'll keep the ones on margin that I bought at 40% lower. So that's how I'm going to play it. Right, we got 2 minutes to go. 2 minutes to go. And there goes the market. Now, defensive is going back up, Coca-Cola is going back up, and the S&P is going down. Now, there's no point buying yet because, as I say, it was all priced in. We haven't got anything new. We got what we expected. What's the reason for buying? There really isn't one. You're not giving me a reason yet. The only way I can buy in mass, use that 384 grand, is to buy the S&P at a lower price. It's not at a lower price at the moment. It's at the price it was before. Nothing has really given up. The market isn't growing that much. So we got to see how we go. Right, 1 minute to go.
13 consecutive day of gains and a winning
We're
streak.
waiting for Jerome Powell to take the stage.
We're already seeing this pre-Powell positioning where those gains that we had are coming out of the market. So the tech XLP is down about 0.25%. The small caps will have to check out as well. Those surged to an all-time high. Silver was part of that trade. The
exactly what I just said, right?
A little more than 300 points. A few moments ago, Kilburg gets up 206. So you see the potential for this market to take this and run with it in a dovish direction, but it's going to be really important how Powell emphasizes whether the QE that they're doing is simply bill purchases to help maintain the plumbing of the system, or something more meaningful, along with everything else he's about to comment on.
I don't think he's going to give us a look underneath the hood to that extent, but you're absolutely right. That's what the market's going to decipher by the end of the week, and that's why I think the longer, bigger picture here is that Treasury yields, we got more than we actually bargained for today with that 25 base rate cut.
So to your point about 20 times out of 20 times, by my math, and I went to an engineering
So
college,
we're waiting for Jerome
100%.
Powell to take the stage. Here we go.
That stocks are going higher over the next year on this cut.
It's not going to be a straight line, Sully. It never is. But when you see the VIX in conjunction with that stat, when you see the VIX, the decay in the VIX, just remember 2 weeks ago when we were a little bit squishy about the actual Fed interest rate cut happening or not, we saw the VIX go up to 28, went back down to 15. When you see that vol get crushed like that, that's when you see people really feel good about equities on a 30-day lookout. And then, yes, that's that, Sully, 20 out of 20 times higher a year later.
What are you listening for as he kicks this off, Kilburg? What kind of feeds to you the
Here we go.
bullish narrative
Stand by.
bringing some doubt into what they've just done?
I think I want him to really kind of give his understanding, will he be sitting on his hands in the next quarter? Because a lot of folks are thinking that we are going to see a rate cut, if not two. Goldman's in the camp that we could potentially get 2 rate cuts in Q1 of 2026. So I want to hear something as he kind of positions the ability to kind of hedge, which he always does a great job of, but that's what I'm really looking forward to get a better understanding. I don't care about the
And there is Jerome
Here's
Powell.
Jerome Powell. Away we go. It's showtime, everybody. The Fed report.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over
SGov,
time,
that's what I buy.
thus supporting
Short-term
effective control of
treasuries.
our policy
There you
rate.
go. Warren Buffett.
I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5% to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem.
New all-time high.
Risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate.
I'm not buying yet.
Accordingly, we judged it appropriate at this meeting to lower our policy rate.
Not buying crypto or Bitcoin yet.
With today's decision, we have lowered our policy rate 0.75 percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time.
He's literally buying SGov. He's literally buying my favorite stock at the moment.
Remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up It's been resilient, and it to another degree, it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy
second
evolves
magic number is coming up.
Just follow up on the SEP. You have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And
in 5 minutes exactly.
What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implications are
magic number.
Productivity.
Magic number
and
in
some of that may be AI. It just also, I think, productivity has just been
in
almost
1
structurally
minute.
higher for
Magic
several
number
years now.
1
So
minute.
if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing.
Here's your magic number to win $2,000.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several
Sensei
people
stream
to support recent
for the magic
reductions
number with
suggests
Sensei.
that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is
there's Sensei's link. He's going to give a magic number out in 1 minute.
Interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the two parts of the mandate, and when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And you know, we come together and we reach you know, a place where we can make a decision. We made a decision today. We had, you know, 9 out of 12 supported it. So fairly
magic number on Sensei Stream.
It's not like the normal situation where everyone agrees on the direction
seconds.
and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, you know, we all have an outlook in terms of what's going to come.
2,
but I think
1
ultimately,
on Sensei Stream now.
Having cut 75, and you know, the effects of the 75 basis points will only begin to be coming in. As I've said before a couple of times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in you know, inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to, you know, the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions. And you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did 2 discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down? Or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year, but when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, you know, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in reserves, in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew. Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussion of that. I'll give you a mulligan though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s.
New all-time high,
way, but
great.
we do have tension between our 2 goals.
Not deploying the rest of that cash at all. I'm holding it in
in my time
SGovs.
at the Fed, and I think going back a long way.
The Fed are buying SGovs, so
in our framework, as you know, says that when that's the case, that we try to take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, it takes, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now, or
No.
change your thinking at all?
No comment on that.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got to, when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break-evens. And, they're at very comfortable levels. They're at levels consistent. Once you get out past the very short term now, break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria. Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path if it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability. And the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing. And it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20. And, that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way, that's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you'd expect new claims to go up. But really haven't much. So it's a little bit curious. Longer term, though, the question is, what are we going to see here? And we don't know. But it's it may be that in past really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
on the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, How would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you, Chair Powell. Christine Romans, NBC News. Wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. What we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time. And so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks, Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? So that's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you'll see you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy. But we've moved back our policy back down to where it's not it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth. We had better labor market. And this is really due to the American economy. We have an extraordinary economy, and people are innovative. They work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
Okay, give my reaction, the magic number, and then we're going to send you to Sensei for analysis on the charts afterwards. So that's what we're about to do. So stand by. Sensei is about to send the audience what he has to me, and we are going to give you your magic number. And let's just listen to what Sensei is saying right now.
Of the speech, we've got the analysis of the S&P, we've got the analysis of the Q&A, we've got every analysis you can think of. I'm also going to tell you exactly what I think about XRP, silver, gold. So stay with me for another 10 minutes. What I'm also going to do is give you a link to Martyn's show. He's going to give you the magic number soon, so I'll tell you when he's going to do that, and I'll give you the link. But firstly, congratulations to everyone who had that had that cheat sheet. If you haven't heard about our newsletter yet, and I know some people will say, why are you talking about it again? Well, because it's FOMC day and we don't do 50% deals.
Okay, I'll just let Sensei know. Send to me, and I'll end. Whoops. End and send back now. Okay. There's Sensei. I'm going to give you the magic number, end the show, and then hand it back to Sensei once again. So just passing on to Sensei. Let's see if he hears this information. And hopefully he does. Just waiting for Sensei to pick this message up. Hopefully he'll have that. Just got to wait a second, and then I'm going to give you my thoughts. I want to give the magic number out once so no one misses it. I'll give you my final thoughts of what we said, what we've seen. And then I'll send everyone back. Okay. 1 minute sending. Okay. It's 1 minute. It's going to go in 1 minute. We're just going to 1 minute. So let me just let you see this.
Okay, here we go. I'm going to send you to Martyn. Okay. 1 minute sending. Okay, so, and you get the into 2026, the Civil War. So you get a very, very important story about 2026 in the Fed, and then good news, bad news. You're also going to get, in about a few hours' time, a full analysis of the speech, full analysis of the SEP, full analysis of the press conference, key quotes from Powell. We're going to compile it and give you my final thoughts. So even if you didn't follow along with the cheat sheet, I'll tell you the answers as well. So you had the cheat sheet, you had the exam, did you pass, did you fail? Well, I'll give you the answers to it as well tonight. That's just one part of the newsletter. If I just show you this very, very, very quickly, you get full access to all of that. You can see what other newsletters are like. You can see what the free tier is. We do have a free tier, but you get a chart analysis course, one-on-one DMs, apps. You get financial.
I'm giving you the newsletter in here now.
Portfolio insight apps. You get deep research. You get a daily newsletter. Get you prepared for the day. It's the best newsletter out there. I'll
Here
tell
it
you more
is.
about it in a
50%
second.
discount.
Magic number of Martyn. That's the link in the chat. I'm also going to give you 50% off only today. Link is in the live chat. Link is in the live chat. Okay, I'm
only.
So Martyn is giving a magic number, add all three magic numbers together, and you got a chance to win $2,000 worth of XRP. I'm going to give you some more analysis now, but if you haven't heard about that newsletter, or if you've ever been on the edge, today 50% off. When those new features roll out, we're not going to increase the price for you, but we might increase the price in the future. This is going to be the best tool in your tool.
So I'm going to do this now. So I'm going to give you the last magic number, and then I'm going to send you all over to Sensei for the final part, and he's going to give you all the analysis. So thank you very much for tuning in. I hope you all tap the like button. I hope you all subscribed. Thank you very much. As we got expected, we got a pause. As expected, it could have gone either way. We got a pause, and as you can see, the market has gone up a bit. Not much though. You can see the market's gone up 0.78. Not too bad, but I'm not buying here. Remember the importance of remaining in the market. Because I remained in the market, I've got another new all-time high, 285, 286. It's a new all-time high. I'm in a defensive position. I protected myself. I bought the Coca-Cola, which is down 0.03, hardly anything, protected myself. We didn't know which way it was going. I used my SGov to protect my portfolio. I've done that, and I've got my, and I'm back in the S&P with 100 grand. See, I'm not like I'm out of all of this. I'm still in the S&P, but I've got another $100,000 or 384 in total waiting on the sidelines. And there is the 111 in cash. So I've got plenty of cash, which is going to go now in SGov as that's what the Fed have done as well. Jerome Powell is buying literally SGov. So what I'm going to do now is give you the magic number and then hand you over to Sensei for the analysis, and I'm going to get off. I've got to finish the show. I've been going live since 6 o'clock this morning and I'm tired. I hope you all enjoyed it. Once again, the final time. This ends at the end of the stream. Your newsletter, your 50% off, the best ever deal. You're now going to get a special after Sensei show for overnight trading of the FOMC as well. So you can win like this. So consistently, I'm making money. I was right. We got a pause, and at the end of the day, I moved into SGov, and you heard today, live from Jerome Powell, they are going into SGov. They're going into short-term treasury bills. It's the right thing to do, but I still remained plenty in the market, bought defensive. I'm now waiting for a pullback, and it will come, and December the 19th will be that carry trade. We've got to be careful of that. So I'm now going to hand you over to Sensei. Here's your last magic number. Make sure that you, sorry, not a pause. I keep saying pause, sorry. 0.25 cut. I beg you, if it was a pause, it'd have been a disaster. 0.25 cut. Right, your last magic number, add all three numbers together, go to the competition page, martynlucas.com/giveaway. There it is, add them all together and enter the competition. We're giving away $2,000 and you're winning 50 tickets by this last magic number. That's it from me. I'm out of here. I'll send you all back now to Sensei. Here is your last magic number. The magic number is 200. 200. 200. 200. That's it. Here is the link back to Sensei. I'm going to give you the link to Sensei now. You can all go and join Sensei because I'm going to end my stream. I've been live since 6 o'clock this morning. Sensei will give you all the chart analysis of the day. There is Sensei's stream in the chat. Enjoy. Thank you very much indeed. I'll see you back in the morning for the opening bell after Sensei's breakfast show. That's it from me. I hope you all made money. I hope you all protected yourselves. I hope you've all made a new all-time high. Don't rush to buy. Take your time. Crypto is going up, but in my opinion, it will pump and dump. Let's see. You can see up and down, up and down. So I would not be chasing this either. That's not the right place for me. That's it for me. Have fun. Sensei will now give you the full analysis. Until next time, as always, I hope you enjoyed it. Take care of yourselves and each other. Bye-bye for now.